Welcome to another episode of Brick by Brick Building Wealth Through Real Estate. My name is Nico James-Bock, and I am a broker with Royal LePage Signature Realty in downtown Toronto. In this episode of the podcast, I'd like to highlight the 5 things that you need to know with regards to the summer market. We are actually more than halfway through the summer real estate market. Remember that the summer market unofficially begins in the middle of May. So we are well into our summer market. A lot has happened. A lot still has to happen. But the fall market will start to take shape in the middle of August. So let's get started. My contact information is in the show notes, so there will be no problems contacting me. Feel free to reach out and to ask any questions you have, or to provide any comments with regards to what you're going to hear today. The podcast is also available as a video recording, so you can see and make reference to the charts and information that I'm showing on the screen. 5 things you need to know about this summer's real estate market. Number one, we are looking to buy. If you're looking to buy real estate, now could be your opportune time, especially if you are a first-time buyer. If you wait for interest rates to drastically change, that is to come down, then you would be considered following the herd. You can miss your window of opportunity as prices will likely increase. Bidding wars will become the norm in certain pockets, and sales conditions that are there to protect you are overlooked or may be overlooked during the offer process. So understanding this can help you make more informed decisions, especially in situations where the crowd might not always be right. You should seek credible, independent information rather than simply following the majority. Buyers sitting on the fence are missing out. Those that are sitting on the fence, a few of them have gotten off the fence as we just came through the first rate reduction from the Bank of Canada after 4 years. There was a rate reduction announcement on June 5th. It wasn't enough to bring a whole bunch of buyers that were sitting on the fence off of the fence, but it did help stimulate the market a little bit. There's another announcement from the BOC on July 24th. So just in about a little over 10 days' time. Number two, rents are going up, so they're climbing. So that is an important consideration if you're going into the market or if you're already in the market. The Canadian rents have soared in recent years. The latest data from rentals.ca and Urbanation, Sean Hillerbrand's Urbanation, shows the average asking rent for all property types. This is May data, May 2024, rose above 2,200. Most recent data indicates that that has inched upwards from our June stats that were just released. So the May increase was up 9.3% year over year, the same jump seen the month before in April. So the trend is upwards, and there's no way around it. If you are in the rental market, then you can expect high rents. If you have a long-term rental agreement, then you are relatively protected. But if you are just entering the rental market, landlords can charge basically almost whatever they want, and they're getting their rents simply because a lot of of people looking for housing can't afford or they don't believe they can afford the down payment necessary for a home. In some cases, that is true, but those same individuals looking are ignoring the pre-construction market, and there are several opportunities of pre-construction and those units that have already completed, but they're still being sold by the builder. So that is a small pocket that is largely ignored by many people. So that's something that should be considered. The third thing that you should know that's important is MOV. So months of inventory is an important indicator. I released the June stats. I released the stats every single month. The June stats were just released a few days ago, last week, and therefore all of the regions. And it shows that months of inventory is quite high, hovering around 4 months of inventory. So months of inventory levels have doubled since June of last year. Homes are simply taking longer to sell. Whenever there is more inventory than there is demand or buyers for that inventory, then homes tend to take longer to sell. However, we're not seeing the downward pressure on pricing that we would expect in such a condition. So normally when there are several months of inventory, more than three and a half, and low buyer interest, basic economics tends to suggest that prices will be soft and prices will actually come down. But that's not what we're seeing. There's quite a bit of resiliency in the GTHA market. Most pockets are seeing leveling off of prices, and some are seeing actually an increase in price. There are also bidding wars taking place for those properties that are priced very aggressively in certain pockets again. So it is very, very important to keep an eye on the pocket that you are interested in and to look at the MOV and to look at what the dynamics that are happening within that pocket. If the market sees 1,000 new listings each month, and each month 250 listings sell, you have 4 months of inventory. So that's how you calculate months of inventory. It's a number of of listings versus the number of properties that actually sell. So a balanced market would be 3.5 to 5.5 months of inventory. A seller's market would be 0 or very low to 3 months of inventory. And a buyer's market would be more than 6 months of inventory. So we are now in most of the pockets, we're in a more or less balanced inventory. That will continue throughout the summer market. But keep in mind that we are heading into a fall market. Fall is typically the second busiest market of the year. For the spring market is the first. We didn't have a very robust spring market because of the high interest rate environment that we're in. However, since we are now in the expectation that rates are falling, we had the first rate announcement, the interest rate fall. First drop in interest rates in this past June 5th. As I mentioned before, July 24th is the next announcement. It's widely believed that it will be another rate reduction. It may be a rate hold, but because of the economic situation, the banks, I think, are going to be a little bit more aggressive with the rate reductions. So that takes me to the fourth factor that you should consider. It's a weaker than expected June jobs report. which is keeping the Bank of Canada rate cuts in play. Dr. Sherry Cooper, who is the chief economist at Dominion Lending Centers, recently released a report. It was on July the 5th, I believe. And it talks about the rising unemployment rate, which is aligned with the Bank of Canada's rhetoric and higher interest rates, stating that it damaged the labor market and strengthened the case for further rate cuts to support the economy. So the economy now is in a situation where it does need a little bit more support. So rather than holding back on the interest rate cuts, I believe, based on not only Sherry Cooper's analysis and very in-depth understanding of economics, I believe that the Bank of Canada will, as I mentioned before, be more aggressive. Population growth isn't likely to slow shortly in the near future, meaning that anything short of about a 45,000 employment gain will increase the jobless rate. So the jobless rate rose to 6.4% and 1.6 percentage points above the July 2002 cycle low. It is also the highest level since 2017. That's excluding the pandemic period, which we've just come out of. There's a strong relationship between inflation and employment. So the Phillips curve is indicating that, or is an indication that the rate of inflation rises as unemployment rates fall. So lower unemployment would mean that people are spending more and leading to more pressure on prices. So whether the BOC cuts the overnight lending rate again at their next meeting on July 24th will depend on the June inflation rate data, which will be released on July the 16th. So just next week, when we see, when the Bank of Canada sees the June inflation data, then it will be more in a position to cut rates if they see that it's going in the direction that they want. They're more inclined to to make another rate cut at the July 24th announcement. The fifth factor or element that you should consider, and that is on the minds of many people, is the condo market. So the condo market will rebound. You can take it from me, who is heavily involved in the condo market and studying the data, not only of the condo market, but of the freehold market as well. The condo market was the hardest hit by the interest rate increases, simply because in the condo market, there are more investors at play, as well as buyers, basically, that need to get into the housing market. So the easiest and quickest way to get into the housing market is through buying a condominium, either a resale or pre-construction. However, because of the high interest rate environment that we found ourselves in, the increasingly high interest rates that took place from March 2022 all the way until basically last month, a lot of investors bowed out of the market, selling their investments because it just wasn't making economic sense for them. And a lot of them were losing money at that rate, regardless of the high rents. A lot of the investors purchased properties that were not yet ready to come to market. So a lot of them pulled out at the during the pre-construction stage, so they didn't even close. And that trend is still continuing, although it's slowing down. So the market conditions for condominiums continue to soften the most of any housing type. 2023 to 2024 has marked a period of adjustment. So we are in that period of adjustment now, which will continue throughout the balance of 2024, influenced by a series of economic and regulatory changes. The end of 2023 into 2024 has seen an unprecedented surge in new condo completions in the Greater Toronto area. So, condo completions are those that are closely watched by urbanation, Dominion lending centers, because that tells you how many units are available to be occupied. So there are a lot of that's what we're seeing now. The softness in the condo market is a result of a lot of the units that were in pre-construction 2020, 2017, 2018, 2019, 2020 into 2021 are sort of now coming into completion 2023, 2024, and 2025. So we're going to see that trend, that softness trend continue. However, it'll be countered by the sheer number of people that are flooding into the GTA. So again, it's going to be tempered by the fact that a lot of these people that are coming into the GTA will be coming into the rental market, not necessarily into the purchase market. So a lot of these units that are coming into completion, some of them are going to remain vacant. But that will change as we move further into 2024 and into 2025. So those condos that are coming into completion, particularly in 2025, will see a more healthy response from condo investors and those looking to move into a condominium, either as a rental or for purchase. While some delays are expected, the large number of units scheduled for the first half of 2024, 17,918, suggests completions in 2024 will likely exceed the 2020 peak. So we're looking at a lot of completions coming into play in 2024. The surge in completions over 2023, 2024 is attributed to a development pipeline filled several years ago. As the market absorbs the influx of new completions and adjusts to the evolving interest rate environment, we're witnessing a transition towards more balanced conditions, which I mentioned before. And this adjustment phase is characterized by cooling investor activity. 2025 and 2026, we will see a reversal of this situation as more people leave the sidelines and even more continue to pour into the GTA, ready to occupy a lot of the units that will be completed. So we're going to get through this cycle. Not to worry, as long as the economics continue in the way that they have been, meaning that inflation continues to trend downwards. The Bank of Canada continues to lower the interest rates, then we will see a reversal of the current conditions, and there is a light at the end of this tunnel. I want to mention that I will be having or conducting or co-hosting, I guess, a seminar on July 25th. The information is in the show notes. It is entitled Navigating These Shifts. So it's really important to have all of the information available so that you can make educated decisions and take advantage of those opportunities that exist. Now is the time to buy. I can't stress it enough. Now is the time to buy, to get into the market, to at least see what's available, and to speak to a mortgage professional. The seminar that I will be co-hosting will be with a mortgage professional from the Dominion lending centers. So we will be able to answer any questions. I will be giving an overview of the real estate market as it stands, and really addressing all of your concerns. If you have pressing questions that perhaps you want to be highlighted during the seminar, feel free to submit them. You can submit them in the comments of this podcast, or you can send me an email or reach out to me through the various social channels. All of the links are in the show notes. That's it for this episode. Ciao, ciao.